Hi, let me ask you a question. Let's say that you were buying an investment property today, and Company A was offering it to you for $300,000, and Company B was offering it to you for $400,000. Now, this is the property of your dreams. It's in a desirable location. All that's different is the price between two companies. Would you pay $300,000 or would you pay $400,000? Now, before you think that's a ridiculous question, the reality is 99% of property investors actually pay the $400,000. Would you believe it? And that's very simply because they're not aware that you can also buy properties, the same property, for wholesale prices. A little bit like going direct to the factory as opposed to paying retail prices. Now, tens of thousands of property investors and real estate professionals rely on our data to help them decide where to invest. The big question we were asked from many of our subscribers was, what do we invest in? And after 3 years of investigating this, we came across this particular strategy that property developers really don't want you to know about. And there's a very simple reason for this. One of the three components, or the costs that are stripped out of the retail price to derive the wholesale price, is the developer's margin. But there's a whole lot more to it. So I'd invite you to register on the right-hand side of your screen, and I'm pretty certain that you'll discover something that might change your outlook on property investment forever. Should we take a quick peek at how this all looks? And by the way, the interactive presentation that you can register for on the right of your screen is in high definition full screen. So how would you buy one new townhouse every year using only the original first deposit? No saving for a deposit every year, no hoping that you've got capital growth to leverage against, particularly if the market is flat. We're going to manufacture that equity, that capital growth. So here, save 126 grand on a new townhouse. It's pretty simple. A developer would pay $337,000, that's the land, the construction costs, but you as the retail investor has to pay the developer's margin. He's not in this for free. You've got to add the selling cost that he adds to the sale price in order to find you through various marketing channels, plus you've got to pay stamp duty. That's the retail sale price. Would you rather pay $337,000 or $420,000? There's a very simple way of doing that. You remove the stamp duty, the selling costs, and the developer's margin, and that's what you have. And as I mentioned, the ramifications are quite considerable. Where you might have had a 7.3% or a 5.6 rental yield, you're now getting 7.3. Rents would be the same, saving $126,000, and you save interest per annum on a mortgage, obviously because you're paying a lower amount. There's a great impact on gearing and, of course, the LVR. We're going into all the details of how to do this, the opportunities that are available, the risks, the benefits, and everything else around it. It's a fairly lengthy, as I say, interactive presentation, so we're there to take your questions, and we uncover all of the aspects of this particular type of method. We're very transparent about what we do, and don't forget, it's all based on the RedWorks Hotspot Central research methodology. So you've got myself, Rich Harvey, and Jeremy Shepherd backing the research and making sure that all these projects stack up. And we're also working with a renowned builder who's done 4,000 of these so far, and over the last 30 years, and it's endorsed by one of the two major lenders. So I invite you to have a look. I think it's going to blow your mind.